bit more of a dovish tone, I think, than some were expecting. Going into yesterday, we had about a 0% chance of the Fed looking at a 50 basis point rate cut. Was really kind of pricing in 25 at almost 100%. Now, hey, there's maybe 33% chance we could go 50 basis points. Where are you right now? And what did Jay Powell say yesterday that may be informing the way you're looking at this market?
Well, I still think, given his past track record and the fact that the Fed in general tends to be a bit more conservative, I would still lean, as the probabilities still do, toward a 25% basis point cut. As you said, after his testimony, I think people got a bit excited that, oh my God, maybe we'll get a 50. But, given the past record, I would expect them to take it slowly as they lean on every time. We'll see what the numbers tell us. And don't forget, he's almost in a little bit of a trap here in the fact that the market has pretty much priced in a 25 basis point cut overall. As you said, anything over a 70 is usually a surety that it's going to get done when it comes to probabilities. So to see 100% probability is something we just don't really see at all. So from that point of view, you also see that that's been the juice that's had the market rally over the last few weeks. In general, I think what's going to happen is, as soon as this is done, the market's going to say, okay, what's next? And it's a little bit of a conundrum. And maybe with that, though, we have earnings coming up. So maybe that will help reinforce that the market needs it. Because, again, we have slowed down, but it seems awfully hard to believe when you see a stock market at all-time highs that we're saying, oh, man, the economy's terrible. I always find it really, really funny to see the market doing so well, and yet, Courtney, everybody comes on every day and says, here are the bad things that are going on right now. This is a terrible situation we're in.
That's so true, and that was sort of the conversation I was having earlier in the hour with Danielle DiMartino-Booth. It feels like you could look at this glass half full or glass half empty, depending on sort of what your purview is. I mean, the market is at record highs. Economic data isn't horrible. Sure, there's some weak points, but look at that jobs report we just had. I mean, do you think that we are is Powell being appropriately cautious, or is he taking in almost too much insight with what's going on outside of the U.S.? I mean, with the global economy and the slowdown we're seeing outside.
Well, I think, and that's why I lean toward a 25 basis point cut, is he is being appropriate at looking at, his job is to protect things and look forward. You do see what's going on elsewhere, and it's a little bit tough not to look forward. And let's face it, we still have the major tariff story hanging over us. It's actually been kind of nice for a few days to have it off the front page. And as we head to earnings, maybe it stays off the front page a little bit also. We get great insight on how things are going with the banks coming up with earnings. And it's going to be very interesting because, let's face it, as you and I both know, rates getting cut and the anticipation of rates getting cut are usually the worst thing that can happen for financials. They've done such an amazing job of cutting their expenses and really managing into this. We'll see what they can do when their earnings come out, and more importantly, what their projections are going forward. You would think that in this environment, a bank like Wells Fargo might benefit because the average 30-year loan in a year has gone from 4.52% down to 3.75%. However, I don't know that we've seen the amount of demand for mortgages that you would expect with that kind of move in a 30-year mortgage. So those are the kind of insights we need to look at when these bank earnings come out. With rate cuts, are banks seeing the demand for their services? And I don't know that we're seeing that. Both domestically and internationally. So getting some insight on both will be very, very helpful for the rest of the earnings season. And it may reinforce what Chairman Powell said, that we are slowing down maybe more than people think.
Yeah, financials the weakest group yesterday. You make a good point there, JJ. Before we wrap up, now that we've heard from Powell at least one day, we've got another day today. How are you putting this all into play when you're utilizing a strategy for the market?
Well, I think that what we see with our clients, particularly, we just released our IMX on Monday, which shows what TD Ameritrade clients, those who actually made a trade last month, are doing. The interesting data there, according to us, for the first time since November of 2016, they are sellers of assets. They sold stocks, they sold bonds, or fixed income overall. That's very unique. It could be that because we had such an amazing first half, and going back to where we started, it was an amazing first half, no matter how much people wrung their hands about worry. our clients were taking profits. And, you know, one of the stocks that they sold is Apple. It's the most widely held stock at our firm, but it was the #1 sold stock for the month of June. So it seems like the investor, how they're looking at the market, maybe some of this wall of worry is coming, and with that, they want to take some profits ahead of perhaps the slowing of summer, or, you know, tariffs, or, you know, all the other news that's kind of out there. So I think we also forget there's still Brexit on the horizon, et cetera, because we've had so much other news. So I think caution being sort of the word of the day, like we started with Chairman Powell.